So I said this before, when you invest in a dividend-paying stock or ETF, you give yourself a raise for every share that you buy. So in this video today, we're gonna explore dividends, what they are, and how you can use them to grow your investment portfolio. Dividends are a share of a company's profit paid out to the shareholders. They're typically paid in cash, but can also be paid in the form of additional shares of stock. Now, dividends are usually paid on a regular basis, such as quarterly, and can provide a steady stream of income for investors. What's really cool about that is anytime that you pick like your favorite company to invest in, and that company pays dividends, you ultimately become an owner of that company by way of being a shareholder. If the company profits a lot of money and they're able to pass those profits on to you in the form of a dividend, that's how you can make money on top of your investment simply for just being invested in the first place. Now, that does mean that companies that pay dividends are often mature companies. They've been around for a long time, they're very stable, and they have a long track record of growth. These companies are generally considered less risky than non-dividend paying companies and are often sought after by income-seeking investors. But let's talk about how you can use these dividends to grow your investment portfolio. See, dividend investing involves investing in those companies that pay dividends, and then what you do is you take those dividends and you reinvest it back into the company every time those dividends are paid out. This is known as the Dividend Reinvestment Plan, otherwise known as DRIP. Now, by reinvesting your dividends, you can take advantage of compounding returns, which can significantly increase your long-term wealth. So dividend reinvestment is a powerful tool that can help you achieve your investment goals over time. So with that in mind, how do we actually identify dividend-paying stocks? Well, there are a few things that you're gonna wanna look for. First, you need to look for companies that have a consistent record of paying dividends every quarter or every month. Second, look for companies with a high dividend yield, which can be calculated by taking the dividend payout divided by the stock price. And third, look for companies with a sustainable dividend, which means that they can continue to pay those dividends long into the future based on their past performance. Now, if we're talking individual stocks, some very popular dividend-paying stocks include, but are not limited to, blue-chip companies such as Coca-Cola, Johnson & Johnson, and Procter & Gamble. These companies have a long history of paying consistent and sustainable dividends and are often sought after by income-seeking investors. Now, of course, I gotta pull up Seeking Alpha to show you some of these companies because it takes you behind the scenes. It is my favorite investing research tool. In fact, you can get a discount if you want to get this as well. Link down in the description below. But let me pull up one of those companies as an example. Let's start with Coca-Cola. So KO, you know, a lot of people drink Coca-Cola products. So let's take a look at that. Now, right now, up here is the share price at $60.14. We're not so worried about that. We're more worried about the three things that we just talked about. The very first thing is, what is the dividend yield? So right over here on the right-hand side, you can see the dividend yield, which is right here, is 2.97%. And again, that can be calculated by taking the dividend rate right here of $1.76, and then you divide that by the current share price at $60.10, and that equals, if you convert this decimal into a percentage by moving the decimal over two places, that's about 2.93%. Very close to what we see here at 2.97. Now, of course, that rate will adjust based on the current stock price of whatever day you're looking at the share price of the particular stock or company. But how do we know if it pays consistent dividends, and how do we know if it has that growth potential in the future? Well, what you want to do on whatever stock that you decide to pull up here on Seeking Alpha, hop over here to the dividends tab. It's about the fifth one in right at the very top. We're going to click on that, and then it's going to give us a wealth of data. We're going to see things such as the dividend safety, the dividend growth, yield, and consistency. We're looking for, of course, B and A rated grades in this particular category, but also we want to look at a few more things. We see our dividend yield, we see the annual payout per share, and we see the 5-year growth rate of 3.53% with dividend growth over the last 60 years. Now that is, of course, because Coca-Cola is one of those champion dividend stocks, probably one of the stellar students. The fact that they've continued to grow their profits and grow their dividends paid out to shareholders for the last 60 years with a 5-year growth rate of 3.53%, that is great. Those are the type of things you'll want to look for if you're interested in dividend investing. Now you can see right here, they pay out their dividends every quarter, which means every 3 months, based on however many shares you own, and the amount was 44 cents per share of Coca-Cola. So if you owned 100 shares of Coca-Cola, you multiply that by 44 cents, which means you're gonna get $44 in addition to whatever your growth is on that particular investment. And then if you buy another share, you get another 44 cents. 2 shares, you get 88 cents. Every share that you buy, you're giving yourself a dividend raise. But let's do a little bit of math to see the power of dividend investing. Now let's say you invest $10,000 into a dividend paying stock that has a 4% dividend yield. That means you're gonna receive $400 in dividends every single year that you stay invested. And if you take that money and you reinvest it back into the company with the dividend reinvestment plan, assuming a 7% annual return, your investment will be worth $28,000 in 20 years. And that assumes that you're only reinvesting the dividends and you're not investing any more money out of your normal investing strategy. Now, assuming that you're younger and you have plenty of investing years ahead of you, let's take a look at the portfolio visualizer. If we invest in Coca-Cola, for example, and we invested for the last 15 years, from the year 2007 until the end of 2022, and we only put in $10,000 on the very first day of 2007, but we didn't invest any more money. And we're not gonna actually reinvest the dividends, which means anytime that Coca-Cola pays you dividends, you're gonna take those dividends and you're gonna run with them. That's what you're gonna do. So you're not gonna reinvest at all. Let's see what happens over the course of 15 years. We're gonna analyze the portfolio, and you can see your $10,000 balance grows to $25,418 over 15 years. Now that's not too bad, but let's take a look at the difference if you decide to reinvest those dividends, because you don't need those dividends, you don't need that money. You want that to continue to pile on top of all this growth that happens over that period of time. Let's see the big difference. Now, remember this number, $25,418. I'm gonna come up here to the portfolio visualizer, and I'm gonna say, yes, reinvest the dividends. Come down here and hit Analyze Portfolio. I hope you remember that number, because now look, the difference of reinvesting the dividends with the same amount of money that you started with grows to now $41,457 as opposed to that $25,000 that we looked at earlier. So if you're not yet needing the dividend income, let that grow you money, because when they reinvest the dividends, you're gonna get additional shares, which means your shares are gonna earn you more dividends, and it becomes this big snowball. And before you know it, you look back and you're like, oh man, that's awesome. So dividends provide that steady stream of income that can help you achieve your income goals. Now make sure you subscribe for more dividend videos. And the most important thing to remember in any case is that dividend investing is not a one-size-fits-all approach. So you gotta make sure you do your own research. Don't just go out and buy a bunch of Coca-Cola. Look into the companies, look into the ETFs, and try to find the best ways to do that. Now, if you're looking for a way to automatically diversify where you don't have to put all of your money on a single stock, just in case like Coca-Cola goes like bankrupt or something, then what you wanna do is look into ETFs. That'll give you an immediate diversification. In fact, there's a few ETFs that pay you monthly. Check out this video that'll tell you all about it, and we'll see you on the next video.